Welcome to House Lux Estate, your go-to channel for all things investment and real estate. Today we are going to explore an exciting topic, how to invest in foreign markets as a beginner. In the world of investing, diversification is a key player. It's like a safety net, offering protection against the unpredictable nature of markets. One way to diversify your portfolio is by venturing into foreign markets. This might sound intimidating, especially if you're a beginner, but don't worry. We're here to guide you through the process, breaking it down into easy-to-understand steps. We'll start with understanding what foreign markets are and why they matter. Then we'll delve into how you can research these markets, choose the right brokerage, and finally, how to diversify your portfolio effectively. Are you ready to broaden your investment horizons? Stay tuned. Before diving into foreign markets, it's crucial to understand what they are and why they matter. Foreign markets, also known as international markets, are markets outside of your home country where you can invest your money. These markets encompass a variety of industries and sectors from around the globe, giving you an opportunity to diversify your investment portfolio. So why should we care about foreign markets? Well, there are some potential benefits. Firstly, investing in foreign markets can provide access to growth in emerging economies. Countries like India, Brazil, and China, for instance, have seen significant economic growth and development over the years. By investing in these markets, you're essentially getting a piece of that economic pie. Secondly, foreign markets offer diversification. It's the classic, don't put all your eggs in one basket scenario. If your domestic market takes a hit, your foreign investments might offset those losses. This diversification can help to reduce risk and potentially increase returns. However, it's not all sunshine and rainbows. Investing in foreign markets also comes with its own set of risks. Market volatility, currency risk, political instability, and differences in regulation and corporate governance are all factors that could impact your investment. For example, if the currency in the country you've invested in weakens against your home currency, the value of your investment could decrease. Furthermore, information about foreign companies might not be as readily available or as reliable as it is for domestic companies. This lack of transparency could make it more challenging to make informed investment decisions. Lastly, while the potential for high returns can be enticing, it's important to remember that high reward often comes with high risk. Emerging markets can offer substantial growth opportunities, but they can also be more volatile and risky than more established markets. Now that we have a basic understanding of foreign markets, let's move on to the steps to start investing. Step 1 in our journey to foreign market investment is research. Now let's dive into the world of knowledge. Unearthing the mysteries of foreign markets might seem like a daunting task, but it's an essential step. You see, every market has its unique rhythm, a pulse that carries the beat of its economy, political stability, and growth potential. Understanding these beats is the key to unlocking profitable investment opportunities. Researching foreign markets is akin to decoding a puzzle. Each piece of information you gather adds up to form a bigger picture. One of the critical pieces of this puzzle is the economy. You must understand the economic indicators of the country you're interested in, such as its GDP, inflation rates, and employment figures. These factors can give you an insight into the health of the country's economy and consequently the potential for your investments to grow. Next, you'll want to look at the political stability of the country. Politics can significantly impact economic trends. Countries with stable politics are generally safer bets, while those with political turmoil may hold higher risks, but potentially higher returns. Lastly, don't forget to consider the growth potentials. Emerging markets can be a goldmine for investors willing to take on a bit more risk. These markets might have higher growth rates compared to developed markets, offering a chance for higher returns. Now, you might be wondering where to gather all this information. Well, there are plenty of resources out there. Websites like Bloomberg or the Financial Times offer comprehensive coverage of global markets. You can also check out economic reports from international organizations like the World Bank or the International Monetary Fund. And don't forget to use the power of social media. Following local news outlets or financial influencers from the country you're interested in can provide valuable on-the-ground insights. Remember, the goal here is not to become an expert overnight. You're building a foundation of knowledge that will help you make informed decisions about your investments. Remember, knowledge is power when it comes to investment. Once you've done your research, the next step is to choose the right brokerage. Now, this is where things get interesting. Choosing a brokerage isn't just about picking the one with the fanciest website or the most ads on TV. It's about finding a partner who will help you navigate the sometimes stormy seas of foreign market investment. First, you want to ensure that the brokerage you choose has availability in the market you're interested in. Just like you wouldn't hire a French tutor to teach you Japanese, you wouldn't choose a brokerage that doesn't operate in the market you want to invest in. Some brokerages specialize in certain regions or countries, so make sure you do your homework. Next, let's talk about fees. This is a bit like going to a fancy restaurant. You're not just paying for the food, you're also paying for the service. Brokerages charge for their services too, and these fees can vary widely. Some charge a flat rate, while others may take a percentage of your investment. It's crucial to understand these fees up front, as they can significantly impact your return on investment. Customer service is another important factor to consider. If you've ever been stuck on hold for hours, you know how frustrating poor customer service can be. When investing in foreign markets, you want a brokerage that offers top-notch customer service, preferably 24/7, given the different time zones you might be dealing with. Lastly, consider the brokerage's reputation and reliability. This is your hard-earned money we're talking about, so you want to entrust it to a brokerage that's reliable, reputable, and has a track record of successfully navigating the foreign markets. Remember, the goal is to find a brokerage that aligns with your investment goals and needs. It's a bit like dating. You're looking for a good match, and when you find it, it can make your investment journey smoother and more profitable. Choosing the right brokerage can make your investment journey smoother and more profitable. So take the time to choose wisely. You'll be glad you did. With your brokerage sorted, it's time to diversify your portfolio. Diversification in the realm of investing is akin to the age-old wisdom of not putting all your eggs in one basket. It's a strategy that involves spreading your investments across various assets or asset classes to reduce risk. The logic is simple. If one asset performs poorly, the others may do well, balancing out potential losses. In the context of foreign markets, diversification takes on an additional layer of complexity. You're not just diversifying across different types of assets, but also across different countries and economies. This geographical diversification can help mitigate risks associated with economic fluctuations, currency exchange rates, and regional political instability. So how does one diversify in foreign markets? Firstly, consider investing in a mix of developed and emerging markets. Developed markets like the United States, Germany, or Japan offer stability, while emerging markets like China, India, or Brazil present growth opportunities. Secondly, diversify across sectors. Don't just stick to technology or finance because they're doing well. Include industries like healthcare, utilities, and consumer goods in your portfolio as well. This sectoral diversification can protect you if a particular industry takes a hit. Thirdly, consider investing in different asset classes. Stocks, bonds, mutual funds, exchange-traded funds or ETFs, real estate investment trusts or REITs. Each come with their own set of risks and rewards. Having a mix of these in your portfolio can help balance out returns. Remember, diversification is not a one-time task. It's an ongoing process of rebalancing your portfolio to ensure it aligns with your investment goals and risk tolerance. Finally, while diversification can help reduce risk, it doesn't eliminate it entirely. It's essential to continuously monitor your investments and stay informed about global market trends. A well-diversified portfolio can weather market volatility and offer steady returns. And there you have it, a beginner's guide to investing in foreign markets. We've covered the fundamental steps, starting from understanding what foreign markets are and their unique intricacies. We've emphasized the importance of thorough research to gain a solid grasp of the market you're venturing into. We've also discussed the critical role of selecting the right brokerage, one that aligns with your investment goals and offers a seamless experience. Lastly, we've underscored the significance of diversifying your portfolio to spread risk and potentially increase your chances of return. As you embark on this exciting venture, always remember that investing is more of a marathon than a sprint. It requires patience, persistence, and ongoing learning. It's about making informed decisions, not just following the crowd. So take your time, do your homework, and make sure your decisions are well informed. And don't forget to subscribe to House Lux Estate for more insightful videos. Happy investing!